Okay, thanks a lot for coming. Thanks to the organizers for having the paper on. This is joint work with Tobias, Adrian, and Erkko Etula. So let me start with what we find. So we test a factor pricing model in the cross-section of expected returns, and then by that I mean a model where expected excess returns are proportional to their beta with a given factor times the factor risk premium. What we find is that a single factor, the leverage of broker-dealers, explains expected returns across assets. So this single factor is able to explain the expected returns sorted on size, book to market, and momentum, as well as treasury bond portfolios sorted by maturity. And it does this as well or better than standard models. We're going to motivate the factor by theories of intermediaries and asset pricing. And the punchline is going to be that deleveraging is going to measure bad times for intermediaries where the marginal value of wealth is going to be high for them. So let me show you the paper in one slide. This is our single leverage factor model and the cross-section of returns sorted on size, book to market, momentum, and treasuries by maturity. These are all estimated simultaneously. The x-axis here is the predicted expected return. The y-axis is the actual average return. The blue is the 45-degree line. We can see things are lining up very well on the 45-degree line. The size and book to market portfolios line up great. The treasury portfolios by maturity lineup. The only thing we're kind of missing is the past winners momentum portfolio. Just to highlight that this is difficult to price all of these portfolios at once, let me show you the same cross-section, but with only the Fama French three factors. So you can see that things aren't lining up nearly as well. The size and book to market line up okay. The momentum 10 and momentum 1 are completely off, and then these treasury portfolios are essentially flat. Okay, so let me take a step back and motivate where the results are coming from and how we're thinking about this. So we know in asset pricing, basically, as long as there's no arbitrage, we have an SDF that's able to price all assets. And the SDF measures the marginal value of a dollar across different states. So expected excess returns are proportional to their covariance with this SDF. And empirical asset pricing has tried to map the SDF to data to measure the marginal value of wealth empirically. So the traditional approach has thought about this from the perspective of a representative household. So it's tried to measure the SDF based on a representative household's first order condition. So this essentially leads to the SDF being a function of either aggregate consumption or the aggregate wealth, so the consumption CAPM or the CAPM. Now the assumptions necessary for these households' first order conditions to hold are that everyone participates in all markets, that there are no or very low transaction costs, that these households can follow any dynamic, complicated strategy that we want, that they're trading and optimizing all the time, and at a more basic level even that they know things like expected returns and betas of these assets with their consumption to make these decisions. Now we can imagine various frictions like limited participation, rational inattention that might prevent these things from holding. A lot of people have focused on those frictions and how to improve the model. We're going to take a different approach in this paper, and we're going to focus on financial institutions instead. So this paper is going to argue that we should be trying to focus on measuring the marginal value of wealth of a representative intermediary, and that's what we're going to try to do. So if we think about these assumptions, intermediaries participate in a lot of markets. They face low transaction costs. They do follow dynamic, complicated strategies. They're optimizing all the time, and they have statistical models to know things like expected returns at betas, or at least try to measure them. So now we're going to argue that the leverage of broker-dealers measures the marginal value of wealth for these intermediaries, and this is consistent with theories of intermediaries and asset pricing. So let me show you how that works. So the key of these theories is going to be that deleveraging is going to measure bad times for these intermediaries when their marginal value of wealth is going to be high. The easiest way to see that is the Brunnermeyer and Peterson 2009 paper. So in that paper, intermediaries are risk neutral, but they face future funding constraints. Now, not surprisingly, if they face future funding or leverage constraints, they're going to want to transfer a dollar to the states when those constraints are the tightest. So the stochastic discount factor in this model is equal to this variable phi, which is the Lagrange multiplier on their funding constraints. So expected excess returns are equal to the covariance with these future funding constraints. Now, these intermediaries in this model are risk neutral. So when these funding constraints tighten, these intermediaries are going to be forced to de-lever by selling off assets because they can't fund. So leverage is going to be high funding constraints are going to imply low leverage. So leverage is going to measure the marginal value of wealth. And this is also consistent with the broader literature. For example, Giannakopoulos, Groman-Viano, Scarliano, and Peterson, et cetera. Okay, so let me tell you about the data that we're going to use. We use data from the flow of funds quarterly from 1968 to 2009. We measure total assets and total liabilities of the broker-dealers. We measure leverage as total assets divided by total assets minus total liabilities. So the denominator here is equity. Leverage measures how big their balance sheet is relative to their equity. Now the leverage factor is going to be changes in the log of leverage, which we're going to seasonally adjust. So let me show you what this looks like in the data. So the green line here is the log of leverage, and the blue line is our leverage factor. So it's the first differences of the green line. Now you can see these sharp deleveraging episodes, for example, right after Lehman here is the largest one in our sample. Also around LTCM, the 87 crash, the oil crisis going on here. So all times when we expect these funding constraints to be tightened. To give you an idea of the magnitudes for the log of leverage, at the height before the crisis, it's around 40 to 1, and it drops to somewhere around 20 to 1 in just a few quarters. So there's a huge deleveraging episode going on there. To give you some more intuition for the factor, this is the correlation of the leverage factor with several variables. The first is the correlation with the broker-dealer's asset growth. We see a strong positive correlation there. I'll come back to why that's important and what that means in a minute. We see a negative correlation with volatility that's consistent with high volatility means tighter funding constraints and therefore lower leverage. Negatively correlated with the default spread, and then positively correlated with the return on the financial sector. Okay, so this positive correlation between leverage growth and asset growth is particularly important. So what I plotted here is asset growth on the x-axis and leverage growth on the y-axis for households on the left panel, and then for these broker-dealers on the right panel. For households who are essentially managing leverage passively, the relationship here is exactly what you'd expect, a strong negative relationship. As asset values decrease, leverage should mechanically go up, and vice versa if you don't change anything on your balance sheet. For these broker-dealers, we actually see a positive correlation between these two, which means that they're using leverage actively to increase or decrease the size of their balance sheet, consistent with leverage being determined by how funding constrained they are. Okay, so the asset pricing test that we're going to do is a standard cross-sectional test, two-pass regression. We're going to do a time series regression of excess returns on this leverage factor to get leverage betas. Then we're going to do a cross-sectional regression of average returns on these leverage betas. The theory is going to predict that the price of risk for this leverage factor should be positive. The alpha, this cross-sectional intercept, should be 0, so that the betas are fully explaining the expected returns. The R squared should be high, so that the betas are doing a good job explaining this variation in returns. We're also going to look at MAPE here, the mean absolute pricing error, which is the absolute value of these pricing errors, these epsilons, and we can determine how big or small that is. We're going to want that to be small as well. So in the paper, or in the talk, I'm just going to report the results from the cross-sectional regression, but the time series results are in the paper as well. Okay, so the test assets we're going to use here are the 25 size and book to market portfolios, the 10 momentum portfolios, and then 6 treasury portfolios sorted by maturity. What I'm showing in this panel are the prices of risk, those lambdas, and I'm going to compare the leverage factor to several other benchmark models. So we have the CAPM in the first column, the Fama-French 3 factors, adding momentum, and then this PC1 is the first principal component of the yield curve that prices the treasury bond portfolios. So these 5 factors here are kind of the relevant benchmark for each of the cross sections that we're considering. Now what we can see is consistent with the theory. The price of risk for the leverage factor is positive and statistically significant, and this alpha, the intercept, is 12 basis points a year. So essentially 0 and not statistically significant. The intercept is lower than for any of these other models. So now let's turn to some other test diagnostics. So I'm going to look next at the R-squareds from these cross-sectional regressions. What we see is for the CAPM or the Fama-French 3 factors, there's very low explanatory power. Once we include the momentum factor or this bond pricing factor, the adjusted R-squareds jump up significantly. But notice that the leverage factor on its own has an adjusted R-squared that's comparable to the benchmark here. Now we also compute confidence intervals for these R-squareds that say what's the most likely true value of the R-squared given the sample R-squared that we're estimating. For the leverage factor, we find the confidence interval to be from 82 to 100. Notice that's actually larger than the point estimate there. What that's telling you, so even if the true R-squared were 1, you'd never be observing that in sample, you'd always be observing something lower. What this is telling you is that observing an R-squared of about 77 most likely implies that the true R-squared is actually higher than that. And this confidence interval here is substantially higher than the benchmark. Okay, now let's look at these mean absolute pricing errors. So we can look at those overall, but we can also break those down across these different portfolios that we're looking at. So I'm going to break down the absolute pricing errors across the size and book to market, the momentum in these bond portfolios. We essentially know that the CAPM is not going to do a very good job here. The Fama-French 3 factors are going to lower the pricing errors for the size and book to market portfolios, but not much else. If we look at this 5-factor model, the pricing errors are going to be in the ballpark of around 1%, so significantly lower. And our factor is producing something fairly similar to that. Okay, so then this is just graphically showing the same results I just showed you. This is the single leverage factor on those returns. Notice that the size and book to market are lining up really well. These treasury portfolios are lining up really well. The only thing that we're kind of missing on is this MOM10, that's the past winners portfolio, and a little bit on MON1, which is the past losers portfolio. So the other momentum portfolios line up pretty well. It's just those two that aren't priced perfectly. Now you might ask if this factor is driven out if we were to include all of these factors in a regression, if it's really adding something new. So what we do is we run a 6-factor model that has our leverage factor along with all of these benchmarks. What we essentially find is that the only two things that show up significantly in the cross-section is the leverage factor and the momentum factor. Nothing else ends up having a significant price of risk. So HML is essentially driven out. The momentum factor having a significant price of risk is not surprising given the picture that I just showed you. The momentum, including momentum, is going to help nail down that spread better. Okay, so robustness checks, which I'm going to go through each of these. So there's a skeptical view of these asset pricing tests, Llewellyn, Nagel, and Schenken in particular. We're avoiding much of those criticisms. First, we're going beyond the Fama-French size and book to market portfolios. We're using a single factor instead of a multi-factor model. We provide confidence intervals for these R-squareds, and we take those intercepts seriously. What I'm going to show you in a minute is the probability of a spurious factor doing as well as this is doing is essentially 0. We also show in the paper, we look at the individual cross-sections on their own. We find stable prices of risk across each, low pricing errors across each. We report the time series regression results. The betas are significant. We play around with excluding the crisis and changing the starting date. And then I'm going to talk quite a bit later about the leverage mimicking portfolio and also sorting all the stocks in CRISP based on past leverage betas and finding a spread and return that way. Okay, so the first thing I want to address with robustness actually is subsample issues. So the results of these factor pricing models can vary a little bit across subsamples. We find that subsamples around the .com episode are particularly an issue. So remember, the model that we're estimating is expected returns being equal to leverage betas times this risk premium. Now empirically, we approximate that with average returns being equal to estimated leverage betas. Now, if you use a small enough subsample, we want to ask whether or not the average returns over that subsample are equal to the expected returns. So for example, if we look at a 10-year window from 99 to 2000, the average return on the market, excess return on the market, is actually negative. It's hard to imagine if that was really the expected equity premium over that time. And the other thing we're going to show is that there's issues with estimating these betas around the dot-com episode. Essentially, what happens is that the leverage factor is calm or actually slightly decreases, whereas stocks rise and fall dramatically. So because we're missing that time series variation there, the leverage betas are going to try to compensate for those outliers. So what we show is that if you include the market to absorb that time series variation, you're going to get a much better fit on those episodes. So the bottom line is that a two-factor model, including the market, works well across all these subsamples, and it's even stronger if we use the full sample average returns rather than just the subsample. So let me show you some more on that. So if we look at the one-factor model, this is a subsample from 89 to 2009, so basically the second half of our sample. The one-factor model, the adjusted R-squared is significantly lower, but the confidence interval for the R-squared basically says it could be almost anything. If we look at a two-factor model that includes the market, the adjusted R-squared goes up significantly. Notice, though, that the market is actually not priced significantly. So it's not market betas that are explaining the cross-section. Including the market in the time series regression is helping get better estimates of these leverage betas. Now, just to show you that it's really the dot-com episode that's driving it, if you drop the 3 years around the dot-com episode and use the single factor, the R-squared goes back up. And if you use the full sample average returns, the R-squared goes back up significantly as well. Okay, so let me talk about robustness and whether or not the results are just due to luck. So maybe we just picked some factor out there, we got really lucky, and it happened to price all of these assets. I want to assess the likelihood of that happening. So what we're going to do is we're going to construct a purely noise factor by randomly drawing from this leverage factor, from the empirical distribution of the leverage factor, and see how well could that noise factor do in pricing all of these different assets. So what we essentially show is that the probability of finding a mean absolute pricing error as low as we find, an intercept as low as we find, or an R-squared as high as we find, are all essentially zero. In fact, if you look at all these jointly, no matter how many simulations we run, we can't find this to happen. Now this is in contrast, if you were to do this exercise using, say, 4 factors and only pricing the Fama French 25 portfolios, you could actually price these a surprisingly high amount of times. Okay, so the next thing I want to do is look at these leverage sorted portfolios. So before I looked at these kind of pre-specified returns, these already sorted returns. Now I'm going to look at all of the stocks essentially in CRISP. So I'm going to rank all CRISP stocks by their past 10-year leverage betas, and then sort them into buckets. Here I'm just going to do 3. You can do deciles. You can do finer partitions if you want. What we show is that there's a spread in average returns of this high minus low portfolio, and that the ex post leverage betas are increasing across these portfolios as well. So this is again consistent with the idea that high leverage beta corresponds to high expected return, but using the full cross-section of stocks. So the next thing I want to talk about is the leverage mimicking portfolio. So what we do here is we project, remember we have a non-traded factor, we project this factor onto the 6 Fama French benchmarks and the momentum factor, and we use constant weights on that projection. And now we have a traded portfolio that's mimicking our leverage factor. So using those constant weights, what we can do is we can go back farther in time. We go back to the 30s. We can use higher frequency data on returns, and we use monthly data. And also, because this is a traded return, we don't have to estimate the cross-sectional price of risk. We can just use the time series alphas to assess the factor. We do all of that, and the results look good going back that far as well. Now the next thing we can do is look at the mean variance properties of the mimicking portfolio. So remember, what we're arguing is that this leverage factor is a good proxy for the stochastic discount factor. That's true if and only if the projection of that factor onto the return space is the sample efficient portfolio, or the mean variance efficient portfolio. So what we show is that the mimicking portfolio has a Sharpe ratio of 1, annualized Sharpe ratio. And this is significantly higher than these standard factors. And it's nearly as high as the maximum possible ex post Sharpe ratio that you can get of any combination of those factors. So let me show you that with a graph. So we have the standard deviation of the return on the x-axis, the average return on the y-axis. This blue curve here is the sample efficient frontier. This portfolio P is the ex post tangency portfolio. So it's the portfolio that gives you the highest possible Sharpe ratio of any linear combination of these underlying factors. What we can see is that the leverage mimicking portfolio is fairly close to this sample efficient frontier. The slope of these lines is giving you the Sharpe ratio, and we can see that the slope for the LMP is significantly higher than for any of these other factors. So again, this is consistent with this idea that this leverage factor is a good proxy for the stochastic discount factor. Okay, so the last thing I want to mention are these betting against beta portfolios. Remember, economically, what we're arguing is that this leverage factor is picking up time-varying funding constraints. So what these betting against beta portfolios do is they sort stocks by their previous market betas, and then they lever up the low beta stocks to have the same beta as the high beta stocks, and show a spread in returns between these two. So the idea is that if you're an investor who's funding constrained, you would rather hold the naturally high beta, market beta stocks than use leverage to lever up the low beta stocks. Okay? So there's going to be a premium between the naturally high beta stock and the levered low beta stock. Now, how high that premium is depends on how tight funding constraints are at the time. So as funding constraints vary over time, the spread there should vary over time, and the return between those two should vary over time as well. So we show that there's a high correlation between our leverage factor and this betting against beta factor that goes long the levered low beta stocks and short the high beta stocks. And we show that the leverage factor can explain the cross-section of returns sorted on these market betas as well. So here are these 10 portfolios sorted on these past market betas. We see BAB1 is the levered low beta security. BAB10 is the naturally high beta security. We see a decreasing spread in expected returns as the Ferzini and Peterson and Fisher-Black would have predicted. And we also see a declining Sharpe ratio from low to high as well. The leverage betas match these pretty well. And then if you do again, the cross-sectional R squared here of these leverage betas on the expected returns is essentially 73%. Okay, so let me conclude here. So our main finding is that a single factor, the leverage of broker-dealers, can explain a large set of asset returns. So we saw that the single factor competes with a leading four-factor equity pricing model and the bond pricing model. We also showed that the projection of that factor onto the underlying return space picks out nearly the sample efficient frontier, consistent with this factor being a proxy for the SDF. I also showed you that going beyond those initial portfolios, sorting the entire set of crisp stocks on these leverage betas produced a nice spread in average returns consistent with the model. And lastly, looking at these betting against beta portfolios, which are probably economically the most interesting portfolios to look at, we also showed that we can match those as well. So now we also didn't just explain these portfolios, the momentum portfolios with the momentum factor and the size portfolios with the size factor. We argued that this factor is economically meaningful and it measures an intermediary SDF or the marginal value of wealth of these intermediaries. And then continuing to study the empirical link between intermediaries and risk premia seems like a promising way to continue. Okay, thanks.